Hello traders. In this video, we will cover a full course on smart money trading, from a starter level to an advanced level. By the end of the video, you should be able to have enough knowledge to slowly become profitable, of course, with patience and practice. So without making the introduction longer, let's get started. The first chapter is market structure. The market has three types of movements. The uptrend. The uptrend is the price structure that repeatedly breaks highs and maintains the price above the last lows. The uptrend is confirmed once price first goes up, then retraces back, breaks the previous high while not breaking the previous low, and this process usually repeats until a reversal pattern that we're going to talk about soon. So the price again retraces, doesn't break the last low, so the pullback ends above the last low, then price breaks the past high, and so on. This was a representation on how high time frame price action looks like on an uptrend, but usually the market structure is not that easy. You will more often see price look somewhat like this. So the uptrend starts by a price movement to the upside, then a pullback. Notice how the price structure looks different than the structure from the last representation. But the direction is the same. The reason is that the pullback from the uptrend is actually a low time frame downtrend that turns into a reversal into an uptrend. Basically, the end of the pullback is where both time frames. So the high time frame and low time frame align and move in the same direction. Then the uptrend confirms after the time frames align and price breaks the last high. And essentially the same type of high time frame price action repeats until a reversal. The low time frame downtrend in the high time frame uptrend. So we are talking about the pullback. It will likely look different since obviously price reflects the buy and sell orders that are executed so fast, especially on liquid markets like Forex and the stock market. But the direction is the same. We will shortly cover why price action differs but has the same direction, and it's all related to liquidity. The second type of market movement is the downtrend, oppositely to the uptrend. The downtrend is a market structure movement that repeatedly breaks the past lows while holding the price below the last high. This movement is often characterized by a lower low and lower high. So the high time frame trend is a downtrend. Then the pullback on a downtrend is to the upside, meaning that this pullback is a low time frame uptrend that reverse and align with the high time frame trend once the pullback ends and practically after it dumps down and breaks the past lows. This is the simplest explanation and representation of the downtrend. Now let's learn how price action actually looks like on a more complex example. So in a downtrend, the price action starts by a downside movement, then a low time frame uptrend on the pullback, and then a break of the lows. This structure repeats. Pullback to the upside, but the upside movement is unable to break highs, then downside movement and break of the lows. The downtrend is a market that favors short sellers over buyers. The third type of market movement is the sideways market. The sideways market is represented by price action that is not trending and is moving towards the same levels. This type of market is often seen right before a trend reversal. For example, you will often see from an uptrend price stops the uptrend characteristics of breaking highs, but it also doesn't break the lows. This price action shows a psychology change in traders. Why does this move happen? For many reasons like buyers closing their positions, buyers not opening more buying positions, but also short sellers aren't that active, so it leaves price moving towards the same highs and lows for a short time period. These sideways market structures usually indicate a reversal. So coming from an uptrend into a sideways market, the price breaks the lows of the sideways market and turn into a downtrend. The sideways market is very hard to properly trade because the movement and order flow is so unclear. There is a good change you might get trapped in the wrong direction and obviously unwanted large losses in our trading account. So the key word, the secret of this sideways market is to wait for this boring structure to break either side and look for trading opportunities after. Strong and weak levels. A strong level is a price level that price action has shown that it is very hard to break. And a weak level is a price level that price action has shown that it is easy to break. So let's look at the simple uptrend. This is the low of the first movement. On uptrends, we know that lows are not broken. So this is the first strong level. Then price going up, pulling back and breaking the high. So by confirmation of the uptrend, the lowest point of the pullback is the next strong low, and the high that broke is the weak high. And this markup repeats.